When it comes to the race for dominance in the athletic footwear industry, the battle between Nike and On is heating up. But according to Jefferies Analyst, Randal J, Konik, one brand is pulling ahead, and it might not be who you think. Let's dive into why Konik believes Nike is outpacing On, and what this means for the future of both companies. Konik points out that Nike's Vomero Plus is making waves in the market, outshining On's Cloudsurfer Max in terms of consumer interest and retail sales. A quick glance at Google Trends reveals significantly higher search volume for the Vomero, indicating that the buzz surrounding Nike's latest running shoe is undeniable. This momentum aligns with Nike's positive outlook on their order book as they head into the holiday season, further solidifying their position as a top contender in the industry. But here's where it gets interesting. How does this affect On Holding AG? According to Konik, Nike's renewed focus on product innovation, particularly in the running category, and their strategic correction in wholesale distribution could pose a significant challenge for On. As Nike strengthens its presence in the market, On's growth in key markets could potentially slow down. And this is the part most people miss. Much of On's past wholesale growth occurred during a period when Nike was scaling back its in-store presence. However, with Nike's order book trending upwards and retailers eagerly anticipating their new releases, the tables may be turning. On's limited expansion opportunities in the U.S. market could lead retailers to shift their budgets towards Nike's products, leaving fewer orders for On. Retail buyers' enthusiasm and spending could pivot back to Nike, potentially constraining On's future growth. On recently reported its second quarter earnings, revealing a net loss of 40.9 million Swiss francs compared to a profit of 30.8 million Swiss francs in the previous year. Despite this, net sales increased by 38% to 749.2 million Swiss francs. The company even raised its 2025 guidance following a strong quarter and continued momentum. However, Konik remains skeptical. He downgraded On's shares to underperform after the brand's first quarter results, predicting that 2025 could mark the peak of On's sales growth rate as U.S. door count expansion slows and sell-in moderates in 2026. Additionally, On's high pricing and narrow product range limit its total addressable market, which could hinder its long-term success. To truly understand the dynamics at play, let's consider Konik's perspective on lifestyle brands. A genuine lifestyle brand offers a diverse range of footwear and apparel, something Nike excels at. On the other hand, falls short in this regard. On's apparel offerings are highly technical and expensive, preventing the category from achieving substantial growth. This limitation restricts the brand's total addressable market, making it challenging for On to compete with Nike's broad appeal. While Wall Street projects earnings growth of 20% or more for On, Konik isn't convinced. Rising fixed costs pose a risk to On's ability to execute effectively. If growth slows and expenses increase, meeting these ambitious forecasts could become a daunting task, potentially impacting On's valuation. Meanwhile, Nike's Vomero 18 has already surpassed the $100 million mark since its February debut, signaling a promising turnaround for the brand in the running category. In June, Nike's CEO, Elliott Hill, expressed confidence in the company's recovery during the fourth quarter earnings call. From here, we expect our business results to improve. It's time to turn the page, Hill stated. 3 specialty retailers confirmed to Footwear News last month that they too believe Nike's running division is on the mend. So, what do you think? Is Nike's resurgence inevitable, or does On have a fighting chance? Share your thoughts in the comments below.